Today is Wednesday, June the 1st, and that means it is Bank of Canada Announcement Day. And there were no surprises today, as for the fourth meeting of 2022, the Bank of Canada announced a 0.5% increase to the overnight lending rate, which means that the prime rate will increase from 3.2% to 3.7%. In the press release that accompanied today's announcement, there were two things that stood out to me. The first is the reading of the Canadian economy. Demand remains very strong, and there are signs and indicators that the economy is operating over full capacity. Employers are noting that there is a lack or shortfall of employees, suitable employees for roles. That's driving up wages. We're seeing some modest growth to the Canadian economy. And the bank did announce or indicate that they expect inflation to remain elevated short term. The second thing that stood out in today's announcement was a clear indication that the Bank of Canada believes that they will need to continue to increase the prime rate as the year progresses in order to curtail or curb demand to bring inflation back in line. Now, there are signs that things are starting to slow down, that the effects of raising or rising interest rates is starting to impact households and businesses. We are starting to see a deceleration of inflation in the United States. It's only a matter of time before that starts to happen here in Canada. And also, we are bracing in Europe for a recession, which will have a trickle-down effect into North America as well. And as inflation peaks and as we head into a recession, that would be a trigger for the growth or the acceleration of interest rates to stall, and may even be a trigger for interest rates to start falling within the next 12 to 24 months. So where does that leave you? We have the Bank of Canada indicating that they're going to raise interest rates, and then we have this counter force that is the specter of a recession that would bring interest rates back down. And I think there's still a lot of murkiness or volatility in the future, and I think that you want to stay the course if you're in a variable rate mortgage. Wait to see what happens. These are not the conditions to be locking into a 5-year fix. I've included a follow-up video, 3 reasons why not to lock into a 5-year fix currently. But if you have any questions about your specific circumstances, I'm just a phone call or an email away. My name is Chris Mulder, and I look forward to checking in with you next time.